Hell is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, I just received a terrifying email with a report that indicates that hell is coming not just for the U.S. economy, but for the markets as well. I'm going to show you one chart that's going to change your whole perspective on the state of the U.S. economy and just how far the markets could sell down based on this one expert's advice. And when you put that in pair with the machine positioning, as you're about to see, we're set up for another big move down in the markets, because this is our Sunday show, the show that makes you money, where we like to look at the technicals, momentum, and machine positioning every Sunday to help you make more money trading and investing. Plus, we have a sponsor for today's show. We'd like to welcome Envoy Medical. You can find them on the NASDAQ under the symbol COCH, and the reason you do is because when we feature a stock on this show, it tends to go straight up right after we feature it, and I'm going to show you a chart setup that indicates a potential 15% move, and it's going to go fast because this company has announced some big news as they have pioneered a one-of-a-kind fully implanted devices for those suffering hearing losses. Stay tuned to into the show or check out the pinned comment or description for more information. Now let's head over to Bank of America with the report. I just received this from Michael Hartnett, the investment strategist at BFA Global Research. And he says the big picture right now is the lowest interest rate small businesses can borrow at is at prime. And in real terms, U.S. prime rate is 6.5%, the highest this century. Now, why does this matter? Because right now, everything about the U.S. equity market is keyed to the labor market. And this chart is going to change your whole perspective and why we're about to see another big move down in stocks. Because the higher for longer real rates slowly and decisively are hurting the U.S. consumer and labor market, and global rate cuts now are no longer a question of if or when. The simple question we always ask is, will they work? Well, we know they won't, but let's take a look at this chart, because here we start to see the U.S. prime real rate in terms of percentages is now the highest level in 20 years, and this is a big issue for employers, because when they start to lay off, well, that means, of course, as we know, the equity market, based on that last non-farm payroll report, is already key to move down, and this will change everything. As you can see here, small businesses are pulling jobs market lower as we look at the small business loan availability versus U.S. initial jobless claims. Remember, the market championed initial claims last week, saying they're indicating the labor market isn't that bad, but if they continue to follow the path here of small business loan availability shown in dark blue, well, as BFA suggests, we're about to see a big change in the labor market, and with that would be stocks. And Hartnett notes that the technical levels would flip the Wall Street narrative from soft to hard landing have not been broken. He wants to see 4% on the 30-year Treasury for one of those, and about 50-50 on the S&P 500. But the problem is, if we see the market break its 200-day moving average, well, watch out. They say 10% lower, and now you can see exactly why I'm terrified, because this means the labor market's about to unwind. But that doesn't mean there aren't opportunities to make money in this market. One of those was Envoy Medical. Here you can see them on the NASDAQ under the symbol COCH, and you can see the stock pull down into the supply zone, which we talk about on the show every Sunday, and then it rallied up, it broke through one and into a second, and now it's pulling back right into the support level, and there's the next 15% move higher as it blasts up to this other upper zone. Again, remember, any stock we tend to feature on the show has big moves after we feature it. Got to jump on this one before it goes, because when we look at how Bank of America clients are positioned, even after this dip buying, they're still sitting at a 61% historical equity allocation, which is rather high above the average here, suggesting that, again, we see another sell-off. People are going to be buying the dip. They're going to be selling. And this is what's so critical now as we head over to Goldman Sachs. Another report I got was on CTA positioning this week, indicates that they are going to be, and this will surprise you, net sellers. At CTA and systematic update here, at the time of writing, more than 70% of our modeled trend signals are more than negative across markets and tenor horizons. This is up 38% last week and is the primary driver of the rebalancing flows. And this is something that I mentioned before, is these machines continue to raise the level at which they sell in order to protect their gains. This is something not many investors do, which is why we always encourage people, use stop loss levels, because many of the trend changes are in the short and medium term tenors, which we'll look at, which have the heaviest influence on our model. This will remain fluid, especially for US markets where prices are closer to medium term levels currently. Now let's take a look, because what they note is the percentage of negative trend signals here shown in dark blue. You can see as they go down, well, that means, of course, the positioning estimate goes down. You see in light blue, that is a percentage of negative trend signals going up. You see that trend signal now rising, suggesting the CTAs are going to sell. And sure enough, here is the latest data on a flat tape over the next week. 50 billion to sell, only 9 billion that of the S&P. In a down tape, 77 billion global equities, 18 billion on the S&P. This right now is not the base case, but look over the next month. In a down tape, you can have 211 billion of global equities, 55 billion in the S&P, and this will move the market in a meaningful way. We'll look at the key pivot levels here in a moment, but I also want to talk about what's going on at Metre. Now remember, this company runs very fast algorithms compared with other firms, and right now they're at 56.12 to buy, under 52.69 to sell. But look at this, Friday's closing S&P 53.44. And what this indicates is we're at a position, at a place where we would likely see any further moves down in the markets. The machines are selling here. Let's take a look at where those lines are on the chart. And here we have the S&P 500. Here's the short-term Goldman signal up here. This is far, far away. But right now, you'll notice that the Metre in red and the Goldman midterm have moved up and they got closer. If we do not see a sustained rally here, these lines will continue to rise, or if we see a pullback, look for the machines to sell. Here's a long-term trigger down here, and again, they're going to continue to go up to protect their positions, which is rather important. Because now let's take a look at our screens, because we not only look at momentum, but we also run our own screens on machine positioning. As we take a look now at the S&P 500, remember we talked about how Bank of America, they now say 10% under the 200-day moving average. Well, let's take a look. And momentum is negative still, despite the dip buying. This is key. It means we're not out of the woods yet. The relative strength index is at 45. Remember, under 40 means momentum's to the downside. MACD, even deep in oversold territory, has got a negative cross. Our own Momentum Timer Pro. Now, maybe you struggle trading these tactical indicators. We aggregate them together, smooth them out with a proprietary overlay, and we give you the daily, the monthly, the quarterly, and the semi-annual motions on, of course, momentum. And what are we seeing here? A big pullback on the 1 month, a string of sell signals. This is telling us from a momentum perspective, you don't want to be in here. But from a machine positioning, we just got a signal on our long-term algorithm here, and that says we should buy it open. Now, if you're wondering, how do you access these reports? Well, check out the description in the pinned comment there below. You're going to find information on our sponsor, plus a 30-day free trial to our reports. I'm literally walking you through step by step today how our reports work. Now, one of ours flagged, of course, as you see, our CTA Timer Pro, the machine positioning flag to buy it open. We've got some limited upside here. We'll show you on that. Here's our actual stop loss levels given to our subscribers, so you can mimic the exact trades, and that's the best thing. Everything we show you, you can mimic it perfectly. Now, where do we see upside for the S&P? That's right here to the 50-day moving average. You see the volume underneath here. This is the area of resistance. That's going to the upside. Downside move, you see Bank of America says this tan line. This is the 200-day moving average. They said if it breaks this, you're down 10% from there. This means if you are long the market, this is a time where you want to look at starting to take some risk off, maybe raise your stop loss levels, and look to hold on to your money. Because if indeed what we saw in the Bank of America report is right about funding stress for small businesses, well, it tells us the labor market's going to unwind. And with that, of course, is going to be the equity market. Let's take a look at the NASDAQ 100 here. What we have is the relative strength index at 43. Again, momentum, we did bounce off of that bottom as dip buyers came in, but from a momentum perspective, it just wasn't that big of a move. The MACD, or moving average convergence divergence, still has a negative cross, and then we see 18 consecutive daily sell signals. You want to know when to get back in this market? When we start to see a flip. This is what we look for right here, the sell max up, and then a change of momentum on the daily. But look at this, our machine positioning max short across the board, momentum pulling back. This isn't what you want to see at all. And particularly, I want to go back here to the S&P chart, and I'll show you something on the NASDAQ chart as well. As we look at the weeklies, what do we see here? Relative strength index, overbought. If this thing pulls down, if this market reverses here, you're at a long-term sell signal. You see it again here on the MACD. How about for the NASDAQ? You see the same thing, overbought. And if this thing rolls over and heads down, you're looking at a much larger pullback, much like we saw back in 2022. And that's something right now investors are not prepared for, but we try to prepare you for this on our show, because right now the data indicates the U.S. economy is not as strong as it looks, and the equity market is lacking the flows to keep it going sustainably higher. And that's why, again, we told our subscribers on our S&P target, we have limited upside here, trade it accordingly. Again, why we recommend and give our subscribers the stop loss levels. But right now, we're staying away from tech stocks. That may change, but let's continue on, because small caps, we nailed the call on this. Remember, we told people don't chase that rally up. We're going to see a reversal in small caps, and sure enough, that's exactly what we saw. Let's take a look here at the charts in a second. RSI 44, MACD negative cross. Again, this isn't what you're really looking for to buy back in. We notice again 6 consecutive daily sell signals. This is coming off of match overbought territory. And look at this, our fast algorithm on our CTA models is indicating a max short position. And what do we see from Goldman? They're saying again potential further selling here, and just goes to show that we give you the lead on the machines before they get there. That makes our report even more valuable, because we run a historical overlay and they don't trade with one. Let's take a look here at the small caps. We'll zoom into the 1-year chart, and what do we see? It bounced off the 1-year volume profile right off its 200-day moving average. And again, if we break that, well, watch out, it's heading down in a big way. You can see the last time it broke the 200-day moving average was right here at 182, and then dropped down to 161, and now we're setting up for a potential move lower here, because remember, the supply zone, we talk about this with our sponsor today. Look at this, you get into the sell zone, it goes down. Into the sell zone, it goes down. They broke through. We said don't chase this. Bam, it reverses. Now the sellers are back in control of this. A breakdown up below that 200-day moving average. I think we're all the way back here to this 165 level. And again, momentum to the downside here. This isn't a strong look for the markets at all. Let's talk about some of the calls from Bank of America we said to avoid. How about banking? This is the regional banks. We said watch out on this one, and look how quickly it changed. Our fast algorithm of CTAs is now max short. We're seeing momentum shifting to the downside. Let's take a look at the KBE chart, because it's not something I said we wanted to chase higher, and sure enough, look at that. You got the big drop, a gap down move. This thing just unwound very quickly into this little supply zone. If sellers show up here, look for a revisit down to this lower zone here, right into that 1-year volume profile. But how about another thing we said to avoid? Well, that Bank of America said to buy in, and that was emerging markets. Look at this, relative strength index. 39. This shows momentum to the downside. MACD, negative cross. 17 consecutive daily sell signals. You want to know when to buy? We see it right here. See this max sell? When this flips to start showing buys, our report triggers. We give you an update. We do all the heavy lifting for you. And again, we're telling you stay out of this. Look at this max short on the fast algorithm. Let's take a look at EEM here, because we see further downside risk. But notably, it came into that 1-year volume profile. Buyers came in, bought, saying right here at the 100-day moving average, this is now an area of resistance. It needs to rally maybe up to the 50-day, but right now I just don't see the economic case from a macro perspective that drives emerging markets. I believe this is going to roll over and head to the downside. But something that has upside potential, but maybe not through the end of this month and into early next month, that is bonds. And we look to Nomura, who notes that they are max long. Can you believe that? They went from max short to max long, 111.38 on the 10-year to sell. Friday's close at 112.95. We're not at a sell signal yet, but let's take a look at TLT. We're up 2.4% on this. Many people said, man, you got all these calls wrong. But here's something I want to understand. If you don't trade with stop losses, which we really encourage you to do, and you get on the wrong side of the trade, just use the signals to dollar cost average back in when they indicate, and sure enough, you will find yourself a way out, and we did as well. But we're still in this trade. We do believe long term there's upside potential in TLT. Let's take a look at this. Our screens, our CTAs, max long, and guess who was there before? That was right. We were there before Nomura. Look at this momentum, nearly maxed out on the quarterly, 1 month, and dailies here. And all this suggests is there's further upside. But remember, seasonality right now is the enemy for the bond market. If you're looking to add positions here, you might want to wait until perhaps September sometime. Let's take a look, because what we see, it jumped into the supply zone, didn't get quite to our target, got close, and now it's pulling down, pulling back. There's your 1-year volume profile. There's support is right here at this level of 93.67. A pullback here would actually be constructive. See if buyers reemerge and then set up the next move back up into the zone. So if you're looking to add to the bond market, maybe hold off, see if it hits into that lower supply zone. But let's talk about gold. A lot of people are very bullish on gold, but just appears to be running out of steam. Central bankers just aren't loading up as much on gold. Relative strength index is at 56. MACD's got a negative cross. What we see here, 2 consecutive daily buy signals sitting on this, and that means, of course, not much has changed, because look at our machine positioning on the fast algorithm. We're 35% long. On our slow side, we're 55%. We've got some sell signals mixed in with buys. If you're looking to go long something, there's some other opportunities. Gold isn't really one of them unless you're structurally bullish on gold. From a trading perspective, there just isn't the logic here. You have one top reversal, another top reversal, another top reversal, another one, and here a potential reversal setting up. Momentum is running out of steam on gold. You can see the RSI slowly heading down. Same thing with the MACD, and that means, of course, the same is likely to happen for gold miners as well. Let's talk about what's going on here. 6 consecutive daily sell signals on GDX. We don't think this is where you want to be either. Look at that. We see 55% short side on the fast algorithms. We're accumulating some sell signals here. Let's take a look at GDX, because this is just not convincing to me at all. And here you see a pullback and then a launch, and then you see what's forming here is potential left shoulder. You've got a head. What tells me is you're likely to pull back down to this dotted yellow line. If it does that, you want to, from a perspective of technicals here, you want to accumulate, look for a potential right shoulder to form. But what you see is beginning of a topping pattern building in GDX. This is dangerous. Look at that momentum to the downside across the RSI and the MACD. But how about some opportunities? Well, I've got one coming up. It's not in the dollar, although I do believe the market will push the dollar lower. We've got 6 consecutive daily sell signals on that. It did hit our downside target, which we've revised lower, and we are at a max sell now. That's pretty wild, because if there is a reversal in the dollar, we will flag it. But let's take a quick look, because there is one chart I want to show you that's really key, and here you can see the dollar on the 1-year volume profile. This thing's headed down. The only question is, how low does it go? Well, let's find out next month when Powell and company determine the path of the federal funds rate. But here's one you want to put on your radar. It's soybeans. Now, some of you know that we've been trying to chase a bottom here, but there's something much bigger coming. We've got some daily sell signals, but look at this, a sell max on the 1 month, a sell mid on the 3 month and the 6 month, max short on the slow algorithm, that is. Let's take a look at this chart, because this is the setup you want to keep your eye on, and that is in the commodity space. There are opportunities. You know, if you're trading this market, chasing it, that is, the opportunity is not in equity. Take a look at commodities. It's huge. And let's look at soybeans. Look at this 5-year chart here. And what do we see? That's the dollar. We need soybeans on the screen. There it is. Look at that beautiful topping pattern here. And we've been trying to pick up some of these, hoping to find support. But right now, support is right down here. You get into this zone here, looking to buy. We're going to be looking for a reversal for our subscribers. We see tremendous opportunity in soybeans, and we see tremendous opportunity in the stock for our sponsor for today's show, Envoy Medical. Again, you can find them on the NASDAQ on the symbol COCH. Let's take a look at what's going on with the company. We'll take a look again at those charts where I'm going to show you a potential very quick 15% move. Again, as you know, when we feature a stock on the show, it tends to react quickly because they have pioneered a one-of-a-kind, fully implanted device for those suffering from hearing loss. And they help people regain hearing health, independence, and a sense of adventure with invisible and true 24/7 hearing that uses the ear to pick up sound naturally. Let's take a look, because full-time hearing using your own ear, they've got it. It's called Esteem, and it's a fully implanted active middle ear implant. And it's the first and only FDA-approved, completely internal hearing device for adults diagnosed with moderate to severe sensor-neutral hearing loss. And let's continue, because what sets Esteem apart from other solutions? They've got no external components. They've got novel sensor technology, minimum maintenance, continuous hearing 24/7. That's right, all day, all night, a long-lasting battery, and waterproof design, making it something you can use and enjoy every day. But they've got something coming. It's called a claim. Now, keep in mind, this is for investigational device right now. It's limited by federal law to investigational use only. But if this should come to fruition, you're going to see it could be amazing. And drawing on our innovative path, Envoy Medical is developing, seeking regulatory approval for a new fully implanted cochlear implant, the Acclaim cochlear implant. If approved, that's the key. If by the Food and Drug Administration, it may lead to a shift from partially implanted cochlear implants to fully implanted cochlear implants. But keep in mind, this is an investigational device and will be in clinical trials for several years, and no guarantee that it will ever receive regulatory approval. But let's talk about what the Acclaim is, because it's a designed to function in environments not ideally suited for external components. It's designed to be implanted, rechargeable battery intended to last several days between charges, and it's designed without an external artificial microphone. The device is intended to allow the ear to pick up sound naturally, setting this to be a game changer. And they recently announced inclusion of the Russell Microcap Index. And here you can see that the changes were effective as of June 28th. And our addition to the Russell Microcap Index is an important step in building more awareness about Envoy Medical and the potential high-growth opportunity ahead with our fully implanted hearing technologies. We believe we have an exciting story with a bright future ahead of us, and look forward to more investors becoming aware of our story through addition to this index. And something from of what we see as a political benefit to the company is bipartisan Senate bill seeks to clarify that implanted active middle ear hearing devices are prosthetics, not hearing aids, making them eligible for Medicare coverage. This would be huge for, of course, Envoy. You can find them again on the NASDAQ on the symbol COCH. This alone is going to put them on the map in terms of being able to see their technology get into the ears of many, many Americans, as we noted. Let's take a look, because the legislation was introduced on July 29th in the Senate, and that is key. It's expected to gain additional bipartisan support following its introduction. And the Bipartisan Hearing Device Coverage Clarification Act is a huge step for patients with significant hearing loss who may benefit from solutions that are beyond hearing aids. We know Medicare beneficiaries and their loved ones will be grateful to learn that the senators behind this are committed to clarifying that implanted active middle ear hearing devices are not hearing aids and should qualify to be coverable by Medicare, as already is the case with other implanted hearing prosthetics. And that could be a catalyst that could send stock even higher than what we think in the short term here. You can note the supply zone. This is where you see buyers and sellers. Above here you see sellers, and at this point you saw sellers in this middle zone, when buyers were down here. And as price came down, you see what happened? Buyers stepped in here. You see the volume pickup, and it drove the stock right into that middle supply zone. It broke through there, and then it pulled back. It rallied up a bit, and now it's pulled back again. It's looking to find support, and this is critical when you're trading the technicals and the charts. You're looking for places that hold support. That sets up the 15% move right back into this upper supply zone. And as we zoom in, you can see right here, on this 10-day chart, what do you see? Buyers clearly down here. There's that volume profile line indicating the buyers are here. It's right now at a point where you've seen buyers back here before, setting up again a move higher in the stock price. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.